let's be real here for a second. 2025 is not playing out as we had hoped it would. Certainly not playing out like 2021. The charts have looked super rough. There's been a lot of pain in the market. We're not exactly out here shouting, we're going to make it and throwing $300,000 at monkey JPEGs. So would it be completely insane to see how a bullish thesis can still play out? The bear case is obvious. Everybody's screaming it all over the timeline nonstop. But at the same time, there's a very compelling counter argument to the negativity. So let me lay out 7 solid reasons why BTC and crypto can potentially move to the upside in the not so distant future. Number 1 is the 90-day gold lag. This means that Bitcoin tends to lag gold's price action by around 90 days on average. We all know that gold did an insane year. It absolutely ripped to new highs over $4,300. Great news if you're holding gold. Not great news if you're lined up by the top of the gold bubble, okay? But anyway, the shiny rock performed like 2021 era altcoins. But here's the thing. It hit its top on October 20th. So if that 90-day lag holds, then Bitcoin will be set for a rally relatively soon, which you may not want to believe looking at current price action. I get it. I'm watching the charts too. Number 2, we've got the possibility of a 50-week EMA bounce. You can use the simple moving average too if you don't like the exponential one. They're around the same area, a couple $1,000s apart from each other. For the 50-week EMA, this is a very critical line for Bitcoin. It's a level you want to see Bitcoin recover very, very quickly. Basically stay above it and the bull market is on as it acts as long-term support. You can see the price bouncing off it multiple times while BTC continue to climb higher. Closing the weekly candle under that is extremely concerning because when we drop below, especially if we fail to reclaim it in a very, very short manner of time, okay, then this moving average starts acting as resistance, putting us in a bearish downtrend. So first of all, the bad news, Bitcoin closed below this level on Sunday. There's no sugarcoating how undesirable that is in terms of price action. But if we get a bounce and reclaim the 50-week EMA, that's around $101,000 currently, then it's game on again. We're about 8.5% below that at the time of recording this video. So a lot of work to do, Bitcoin bulls, a lot of work to do. Plus, Bitcoin has closed a CMA gap around $92,000. So that's potentially good enough for the sell-off and is close to making a death cross, which sometimes can signal the bottom before a bounce or the end of all things. Next, key reason, or reasons, I guess, number 3 are, there's 3 of them, QT, QE, rate cuts. Before we get into that, guys, you're not going to believe how insane this current promotion is coming from guys over at Femex, the exchange I've used for years. They just launched one of the most generous cashback deals I've seen in crypto. Put in $5K, you get $500 back. $10K, get $1,000 back. Put in $20K, they're going to give you $1,600 cash back. That's insane for just a $20K deposit, okay? Plus, you can get up to extra $20,000 in bonuses for trading. Femex is secure, they got the deep liquidity, they got the coins you want to trade, and they have global access, meaning anyone, anywhere can use them. You might need a VPN in some cases. Don't sleep on it. Click the link right down below here before this deal runs out. It's only going for a few more days. Check it out. Thank you very much. So, first of all, quantitative tightening is ending. That's official. It's happening December 1st, and just to underline how important that is, quantitative tightening actually started back in 2022. And so this is a major regime shift here. Now, they've already been tapering QT, to be fair. They're only doing about $5 billion a month right now. So we can't overestimate the impact of the end of QT, but I think it's a good narrative for the markets. Then we have the possibility of quantitative easing, or at least some kind of technical adjustments similar to quantitative easing, aka the Fed injecting liquidity into the markets. And don't forget those recent headlines about the Fed meeting with banks. If there are cracks in the system, then what can the Fed do? They don't have very many options. They're going to have to turn the printers on. Plus, we have the possibility of further rate cuts in December, although note that this right now is far from certain. Prediction markets give it about a 50-50 probability currently. There is disagreement internally at the Federal Reserve with a split at the Fed Open Meeting Committee on whether to hold or cut rates. So again, the odds have dropped pretty precipitously from near certainty to flip a coin. But here's a bullish angle on that. If rate cuts are almost certain, the market prices them in. But at the moment, that is not the case. Market is pricing in uncertainty. So if we do get a cut, and it's definitely possible, then it's an immediate catalyst that will not have been priced in ahead of time, and there are still more factors that can trigger price gains, as we'll see, with the next one being TGA liquidity flooding back into the market. As you're no doubt aware, the US government ended its longest shutdown in history, a pause that lasted 43 days and seriously mucked up the plumbing of the financial system. A shutdown like that is the kind of event that markets hate. Causes uncertainty, holds up economic data, and just generally stops the economy from operating smoothly as it's supposed to. Plus, it results in liquidity getting trapped in the TGA. That is the Treasury General Account. There's currently around $1 trillion in the TGA, but with shutdown over, that money can start returning to the markets, bringing liquidity and also signaling that functionality is in general returning to the financial system, which is a positive move. Let's also look at some chart-based reasons why perhaps it's not a terrible idea to remain optimistic. The first of those is the Russell 2000 versus the others chart. Now, the Russell 2000 is an index of small cap US stocks, so it's distinct from the S&P 500, which tracks the largest public companies, and the QQQ, which tracks a smaller number of large public companies, primarily in the tech sector. Now, in crypto terms, you could say that the Russell 2000 is very close in character to the altcoin market, or the others, right? Everything outside of the top 10 coins. So instead of looking at Bitcoin and ETH, perhaps we should look at the correlation of the Russell 2000 to the price action of the others chart. Now, what's interesting here is that the others chart tends to largely follow the Russell. They're similar proxies for risk attitudes. And if you look at the Russell chart now, it has rechased after hitting new all-time highs in October, but can rally again if the right macro conditions return, as in when liquidity starts rising, conditions start easing, and people start taking risks again. So keep an eye on this one. Again, nothing is certain, but we do know that when the Russell 2000 rallies, you can start believing that altcoins more broadly can have a risk-on scenario. The next chart to check out is the copper versus gold ratio. Now, we talk about this one a lot. We're going to keep talking about it because I think it's important. Essentially, this tracks risk appetite. Copper rises when growth increases, while gold leads when investors seek safety. Okay, Bitcoin has historically moved with that ratio, up in expansion, down in contraction. Now, that's been a bit different recently because institutions have been buying Bitcoin. So then think about what happens when we hit expansion. You can see that the PMI, like the copper gold ratio, looks pretty damn bottomed out here. And if the economy shifts back into growth, which it will at some point, when is the question, both the ratio and the BTC then have a track record of climbing together. Finally, the last big reason here why Bitcoin and crypto can have a lot of attention again in the market is the Crypto Clarity Act. Now, you might hate politics. I understand why. Bunch of clowns run everything. But the reality is that this cycle has been influenced by what is happening in Washington, and it's been influenced in a way like never before. One development that can be highlighted as another huge positive coming in the markets is the Clarity Act. Now, this legislation will, as the name suggests, bring clarity to the markets. Regulatory clarity is something the markets have been demanding for a decade now. We're finally going to get it. According to Matt Hugan over at Bitwise, it has an 80% chance of passing by early 2026, giving us yet another reason to look beyond short-term volatility and try to take in the bigger picture on what's actually going on. Thanks for watching.